Decoding Financial Ratios, your guide to business performance. Ever wondered how investors and analysts know if a company is doing well? The secret lies in financial ratios. They're like a business's vital signs, revealing its strengths and weaknesses. Let's dive in and learn how to read them. Financial ratios are simply comparisons between different items in a company's financial statements. They provide a standardized way to analyze a company's performance over time and compare it to its competitors. Think of them as translating complex financial data into easy-to-understand insights. These ratios are calculated using information from the balance sheet, income statement, and cash flow statement. They help us understand a company's profitability, liquidity, solvency, and efficiency. Mastering these ratios is crucial for making informed financial decisions. There are several categories of financial ratios, each focusing on a different aspect of a company's financial health. Let's explore some of the most important ones. Understanding these categories will give you a comprehensive view of a company's overall performance. Profitability ratios measure a company's ability to generate earnings relative to its revenue, assets, or equity. They tell us how efficiently a company is using its resources to create profit. Higher profitability ratios generally indicate better performance. Gross profit margin, net profit margin, and return on equity, ROE, are key profitability ratios. Gross profit margin shows the profit after deducting the cost of goods sold. Net profit margin reflects the profit after all expenses. ROE measures how effectively a company is using shareholder investments to generate profits. Liquidity ratios assess a company's ability to meet its short-term obligations. They indicate whether a company has enough liquid assets to cover its immediate liabilities. A healthy liquidity position is essential for avoiding financial distress. The current ratio and quick ratio are common liquidity ratios. The current ratio compares current assets to current liabilities. The quick ratio excludes inventory from current assets, providing a more conservative measure of liquidity. Solvency ratios evaluate a company's ability to meet its long-term obligations. They indicate whether a company can repay its debts over the long haul. High debt levels can increase financial risk. Debt-to-equity ratio and times interest earned ratio are important solvency ratios. The debt-to-equity ratio compares a company's total debt to its shareholder equity. The times interest earned ratio measures a company's ability to cover its interest expenses with its earnings. Efficiency ratios measure how effectively a company is using its assets to generate sales. They indicate how well a company is managing its resources. Efficient asset management can lead to higher profitability. Inventory turnover ratio and accounts receivable turnover ratio are key efficiency ratios. Inventory turnover ratio measures how quickly a company is selling its inventory. Accounts receivable turnover ratio measures how quickly a company is collecting payments from its customers. Financial ratios are most useful when compared to industry averages, historical data, or competitor performance. This allows you to benchmark a company's performance and identify areas for improvement. Remember, a single ratio doesn't tell the whole story. Analyzing trends in financial ratios over time can reveal important insights about a company's performance. For example, a declining profit margin might indicate increasing costs or decreasing sales prices. Always consider the context and industry-specific factors when interpreting financial ratios. Understanding financial ratios is a powerful tool for students and anyone interested in business and finance. By mastering these concepts, you can gain valuable insights into a company's performance and make more informed decisions. Ready to put your knowledge to the test? Start by analyzing the financial statements of a company you admire. Calculate key ratios and compare them to industry benchmarks. Share your findings with your classmates or on social media using #financial ratio analysis. Let's learn and grow together.